Greetings, Jonathan Camarda, Chief Investment Officer. Hopefully you guys are all doing well. As we come to you right before another Fed week. Boy, time flies when you're having fun, huh? So after the hot PPI data last week, the market took a little bit of a bearish tone since the last time we've chatted here. So what looked like 50 basis points, certainly with your humble host, has turned into perhaps a horse race with another, drum roll please, 75 basis points. So it's on the table, folks. I have no predictions, but that is looking more of a higher probability now than it did just a week or two ago. Interesting this weekend was actually looking at, over different performance metrics and such that I like to do now that college football season's over. Exciting. I looked at, Vanguard, their balanced 60-40 strategy, their balanced fund, still down 19% year to date. Just a crazy year. It just goes to show you the synchronicity there of fixed income with equities. So if you're in a more passive strategy, whether from an advisory or a 401k, more of a fixed plan, a year like this, if you don't have your hand on the steering wheel and the brake pedal, certainly what you expected as that, unicorn of risk management, the 60-40 strategy, certainly turned into more of a charging grizzly. So now as we move on at the aforementioned PPI data, certainly the market's taken, as we said, a little bit more of a red type of tone to it. This year, kind of reflecting as we also move forward, there's only been real 4 sectors that really haven't shined necessarily, but certainly have avoided the clause there, the proverbial bear. They call it the shoe-in. Pardon the pun there, staples, of course, healthcare, which we've been taking advantage of here, utilities, the U rather than the O, so forgive my spelling, and then the E in energy. Now, good segue on energy. You might have noticed that oil is starting to take a hard down turn here after it just seemed like the per barrel was up in the 120s, now down in the 70s, many projecting 65. And you might have also noticed there's been some insulation between the price of oil and the energy sector. However, there happens to now, the correlation is seeming to catch up, and that's where the projections are. So we keep a very close eye on that. In fact, in some of your strategies you've seen, we've already started to take action, realizing that eventually, yes, the price of oil is going to wag the dog, not that, some of these energy companies are going to avert the pain if we continue to see this. Now, there's many different supply-demand metrics, the global macro that we've talked about earlier this year, so we won't go into detail on this episode. However, that's something that we are certainly keeping an eye on. Now, beyond that, what we're also looking at here, a very challenging environment for the Fed. We like to beat up on Uncle Jerry and as such, but very interesting as some of these large institutions, looking over some of the research, very interesting stubborn inflationary dynamics that we have. Where in most inflations as we head into a recession, which, we called several months ago, basically more of like rolling recessions. And certainly we've had an inverted yield curve for a while, folks, right? And that usually predicts, by the way, 90% of recessions, regardless of what you hear on TV. And one of the steepest inversions, again, inversion being higher short-term rates versus long-term rates. And as that number increases between the two, that creates a sharper inversion there for your play-at-homers. So here's the deal. So you have that situation occurring, but here's the situation where most inflation to recession handoffs, where the Fed starts to really tighten. You have large unemployment and large drops and increasing jobless claims. And of course, the Fed has intimated they do want pain on Main Street. They pretty much hit us with that hammer already. What's bad on Main Street is good for Wall Street. Good for the Fed in this situation. However, the stubbornness, the knot in the wood is that we may not see some of those large unemployment numbers. Now, we've seen, layoffs in some of these large tech companies who were overhired perhaps after the pandemic, allegedly. But we may not see that. And upon further review, when you start to look at the employment participation rates, we're in only the low 60s. Okay? And there is a shortage of employees for employers when you look at the numbers. Very interesting. Just in 2008, before that Great Recession, you had upper 60s participation rates. So that may create an enigma for the Fed, an uphill climb. Not that we're shedding any tears. However, it could be worse for business, could be worse for the consumer, and could be worse for the market because the Fed will continue to tighten. But that knot's not going to go away easy with the proverbial axe that's being swung on it. So you could have a situation where we have the old term stagflation. Okay, what we have is stubborn inflation, but low growth, and real painful economy to go through. And so that's why you're looking at a projection again where we're looking at from a market standpoint. We bring it all the way back to the market, right? A little 360. I get there eventually, folks. Where we've been taking more of a defensive posture as everyone's looking at the Santa Claus rally. But Santa Claus, it might have been the Nightmare Before Christmas, right? During the old movie where they combined, the holiday in October into November with Christmas. And we may have already seen that rally. And now we're starting to get this into 23 malaise. And again, this week's going to be telling, seeing where the Fed comes in. But certainly in your strategies, you will start to see, again, the proverbial brake pedal being applied if the macro winds certainly show some of that deterioration. And we've already seen it. The S&P and the Russell 2000 have already shown that they can't hold above their longer-term moving averages. We see more sectors weakening on their longer-term technicals and the such. So this is already, becoming apparent and something that we have a close eye on. So what this all means as well is, old Betty Davis, I believe, said, hey, buckle up, it could be a bumpy ride. That we will be eternally vigilant, keeping our head on a swivel to make the adjustments. And then certainly as your risk tolerance and appetite perhaps delineates between, what the models are actually doing for you, certainly reach out to your personal wealth advisors. They're always there for you to walk you through to make sure that we get that glass slipper on perfectly. And being the end of the year, TikTok, we won't go into that whole global macro issue. This would be TikTok as in T-O-C-K. If you have any tax requests, certainly the time is coming where that stagecoach will turn into a proverbial pumpkin here in a few weeks as things slow down late in the year. With that being said, as always, appreciate your time, patience, most importantly, your trust. Good to see a lot of you folks last week. Again, stay warm, and yet at the same time, stay frosty. Till next time, Jonathan Camarda.